And good morning and welcome everyone to InvoCare's half-year results presentation for the 6 months ended 30 June 2021. I am joined today by Adrian Gratwick, our CFO. I will first make some opening remarks on the key highlights for the half, followed by a more detailed operational update. Adrian will then walk you through our financial results before I cover some perspective on our strategy and outlook, and we'll then open the call for questions. So now to our highlights on today's results. In our strategy presentation to investors in May, we set out what our key performance measures were going to be. These are the KPIs that we believe will demonstrate our success in raising the bar and delivering on our 5-year strategy. I am delighted to report today improvements across all our KPIs in the half. This was the first period in which our leadership team has been in place to guide the business. And with a limited impact from COVID restrictions in most markets during the half, I do believe that these results demonstrate the operational performance opportunities of this business when market conditions allow. Starting first with our customers and people. As a referral business, InvoCare prides itself on maintaining its quality of service standards to inspire advocacy. This continues to be reflected in ongoing improvement in the group's Net Promoter Score, NPS, which was plus 79.3 at the end of June, the highest result in 3 years. I am also extremely pleased to see a reduction in our lost time injury frequency rate, LTIFR, with the recent investments in our safety team and processes demonstrating their merit. LTIs were 18% lower in the half compared to the same time last year. Our operational excellence speaks to a focus on capital and cost discipline. Pleasingly, we have achieved a return to positive operating leverage, and the balance sheet continues to remain in good shape with low levels of leverage, assisted by an exceptional level of cash conversion. Growth has come from high-quality earnings in line with our focus on share of market value, despite only modest growth in case volumes. Case averages have recovered to pre-COVID levels in Australia and New Zealand through our ability to offer our full suite of services in a more stabilized trading environment. We have also been disciplined in managing costs, which has seen earnings growth outpace price and volume increases, underscoring my earlier remarks about operating leverage. In measuring successes in sustainable leadership, pleasingly, our second sustainability report, released to the market in March, has again been recognized as leading by the Australian Council of Superannuation Investors. The strong growth in earnings has also translated to strong growth in operating earnings per share. And we saw a positive trend in our return on capital employed, up 1.4 percentage points from the full year 2020 result. And in terms of strategic achievements, I'm pleased to say we have gathered some positive momentum in the first half. So we announced our strategic reset in May and have shifted the business to a 5-year strategic planning horizon. When we talked about the first phase of our strategy, we've used the phrase raising the bar. We are raising the bar on customer service and the employee value proposition. We are raising the bar in stretching our business to run more efficiently and with higher standards. We raise the bar when we seek new growth, be it traditional or innovative. And we want to raise the bar for the industry in terms of standards of care, sustainability, and community engagement. The early stages of the plan focus heavily on the first, second, and fifth pillars, with growth and innovation to play a larger part in the latter years. In our first pillar, customer-led, people-empowered, we know that by better engaging and empowering our people, we can lift an already high NPS while building a great, safe, and inclusive place to work. We have increased the frequency and granularity of our customer feedback programs to ensure we remain focused on supporting our customers in the best ways possible. Our first externally benchmarked employee survey was also conducted in the half, which gave us real-time feedback on their experience as well as an opportunity to assess their engagement and alignment. The second pillar, operational excellence, considers InvoCare's operating model, network performance, and costs and capital discipline. During the half, we applied a more disciplined approach to investment and project management to complete 13 NBO and shared service projects and to deploy significant enhancements to our Australian funerals ERP. Some less visible but important achievements include reviews into the organization cost base, transitioning the prepaid funerals business to its own Australian Financial Service License, AFSL, and commencement of our debt refinance, which we announced last Friday and which Adrian will touch on later in the presentation. In terms of core growth, beyond developing a new 5-year strategy, we started to focus on our networks, brands, and websites, as well as investing in capacity for growth. Our new growth platforms pillar focuses on more innovative sources of growth. This included our investment in digital memorialization with Memories, which I announced earlier this month, as well as a pet cremation e-commerce platform, and a greater focus on business-to-business opportunities, including a multi-year community agreement in cemeteries and crematoria, as well as national vet network agreements. And finally, I wanted to make mention of our sustainable leadership pillar. During the half, we strengthened the executive leadership team with a role dedicated to health, safety, and sustainability, and another one to stakeholder engagement. The group also undertook a refresh of capability in the safety team and established a new health and safety strategy, looking at key risks mitigation, ways of working, physical and psychological well-being. COVID safety protocols are now embedded in the business, and the recent outbreak and return to hard lockdown conditions has resulted in the re-establishment of a group's COVID task force. It coordinates the company's response and assists our employees in navigating this challenging period. As mentioned, our sustainability report has again been recognized as leading by AXI, and we are currently conducting a materiality assessment to inform our long-term sustainability strategy and initiatives. Finally, we were much more proactive throughout the half when engaging with key stakeholders, in addition to playing a greater role alongside our industry associations. This shift in focus gives us greater insight into emerging issues, as well as the opportunity to advocate for higher standards of care across the community. Now, moving to our operational updates. The Australian funerals business has delivered a strong result, driven by a return to pre-COVID case averages as restrictions on funeral attendees were eased. This has allowed customers to return to their preference of holding larger, higher service funerals, with a strong focus on the gathering elements and increased spend on things like caskets and flowers. There has also been an observed reduction in direct cremation activity compared to the prior period. Operating revenue has grown in all markets, with a 6.6% increase in revenue overall. Volumes remain materially in line with the prior period, but we have seen strong volume growth in some states, offsetting declines in others. A strong focus on controlling costs led to a 5 percentage point improvement in OPEX to sales to 44%. A 44% increase in operating Ebitda to 37.5 million, and pleasingly, a return to positive operating leverage. From a strategic perspective, the continuation of high-quality service has been reflected in the business NPS score of 79.7, the highest score achieved in recent years. The enhancement of the ERP platform project successfully went live, our first major project completed under our new Enterprise Project Management Office framework, and an important step forward in ensuring we optimize our platforms to best support our frontline funeral arrangers. The team also commenced a brand strategic review, starting with value cremations, refreshing the brand's visual identity, website, and business model. Looking ahead to the rest of the year, as I touched on, the current situation with respect to COVID and extended hard lockdowns, particularly in New South Wales and Victoria, are very likely to impact case averages in the second half. However, the extent of this impact and the timing of any change in these restrictions is uncertain and subject to change at this present time. Within our control is a continued focus on cost-based efficiencies and progressing our strategy. We have a pipeline of NBO projects due for completion in the second half, an update of which is included in the appendix. And the network optimization review is also expected to complete towards the end of the year, which should influence portfolio management activities for the coming year. Moving to prepaid, Adrian will touch later on the mark-to-market impact of the accounting for the prepaid funerals business to the group P&L. The continued volatility in mark-to-market revaluations again highlights why the company has historically distinguished its results on an operating versus non-operating basis to exclude the impact of such material non-cash movements. Operationally, the easing of COVID restrictions in the half has enabled the return to face-to-face consultations, with prepaid contract volumes sold growing 20% compared to the prior period. However, the percentage of prepaid funeral redemptions has also remained relatively static at 14.1%. During the half, the business also implemented an AFSL to ensure compliance with revised ASIC guidance for the industry, which previously provided exemptions from the requirement to hold an AFSL for prepaid funerals. As I touched on just before in the funerals update, the current lockdown restrictions are expected to have some impact on our ability to access customer, and potential changes to discretionary consumer spending may also impact sales volumes in the second half. Activities going forward will include a product review, revamp of our approach to package selling, and integration with the relevant brand's local community engagement strategy. The team will also kick off a strategic review to maximize our long-term opportunity for this line of business. The cemeteries and crematoria business continues to deliver strong growth in memorialization sales, up 12% on the prior comparable period, with growth across both New South Wales and Queensland. In Queensland, the benefits of the Allambie remedial works undertaken in prior years continue to contribute to the growth in sales. The easing of restrictions and return to more traditional service levels has seen a 9.7% increase in burials in the half. This sales growth, together with a growth in memorialization, drove an overall increase in operating revenue of 13% against the prior comparable period. An increased focus on park grounds maintenance has slightly tempered the impact of this top-line growth, with 12% growth in operating Ebitda to 13.1 million. In terms of strategic achievements, the business delivered its highest ever NPS score of 74.1, a reflection of the increased focus on servicing client families versus a sales focus. In addition, many initiatives went into our operational excellence pillar for this business, ensuring consistently high standards of safety and other processes across our parks and crematoria. The opportunity of working with religious and community groups on long-term partnership and reservation agreements is a key initiative in our new growth platforms pillar. Pleasingly, this has resulted in the signing of a significant multi-year burial agreement in the half with a cohort of local community groups in New South Wales, supporting their burial needs for many years to come. Additionally, the project to upgrade this business ERP platform has also commenced. Looking to the second half, operations are likely to be impacted by the current lockdowns, particularly in New South Wales, with restrictions on population movements, reducing the number of visitors to our parks, and we have seen a reduction in appointments to view memorialization opportunities. We continue to pursue virtual tours with our customers that expect a slowdown in memorialization activity, the extent and persistence of which over the half remains uncertain. The continued economic impact in New South Wales on consumer discretionary spending may also be a temporary headwind. On the positive side, we continue to broaden our community relationships to drive further B2B opportunities, and our expansion of park products and services is underway. The pet collections business in Australia continued to grow and delivered a 3.6 million Ebitda in the half, with a strong contribution from the two businesses we acquired at the end of last year. Financial results exceeded expectations, with these two acquisitions contributing 12.5 million to operating revenue in the half. The first step in the operational excellence strategy for this business was taken by establishing a national leadership group. The business also continues to pursue product and service innovation opportunities, as I touched on earlier, with a patient-per e-commerce site launched in the half. This allows customers to book their pet cremations online, as well as allowing them to purchase urns and memorabilia. Management continues to pursue national agreement opportunities, leveraging the division's scale, with agreements signed with a number of key veterinary groups in the half. Investments were also made in 2 new pet cremators in WA and Victoria to increase operational capacity in these locations and keep up with the demand. We also executed a small acquisition of a pet disposal business in Metro Sydney, servicing 32 vets in its local market. Looking to the second half, work will continue integrating the businesses onto one ERP system with a consistent operating approach over the next 12 months. We are also looking to expand a range of products and services and e-commerce capabilities, and negotiations continue to pursue national vet supply agreements, as well as potential M&A targets. This is a high-growth market segment, which over the long term will be further supported by the increased pet ownership we witnessed during COVID. The financial results including on this page are in local currency. First with New Zealand. Like the Australian funeral business, New Zealand has experienced continued recovery in case average to pre-COVID levels, the key driver of the 8.8% increase in operating revenue. Growth in case averages was also supported by a return to higher service funerals and growth in catering revenue, with a large sales growth particularly evident in 2 metro markets, Auckland and Wellington, which were hard hit by restrictions in the prior comparable period. The tight control of costs has contributed to a return to positive operating leverage, with operating Ebitda increasing 24% to 5.7 million New Zealand dollars. The hard work and dedication of our employees to support our client families through a high level of service is reflected in another step up in the business NPS, this time by 2 points in the half to plus 86.7. Looking to a second half, like Australia, the emergence of COVID cases in New Zealand and the subsequent lockdowns imposed by the New Zealand government are expected to have an impact on case average and potentially volumes in the short term under their stage 4 restrictions, which remain in Auckland, but the extent and persistence remain uncertain. In terms of what the business can control, the New Zealand network review is ongoing, and the 3 NBO projects that were underway in the half have subsequently been completed in August, with a few more expected to complete within the next few months. Now to Singapore. In May, Singapore experienced a spike in COVID cases as a result of the Delta variant, and the government reimposed tightened measures, restricting catering and the number of attendees at funerals to 20. The persistent COVID restrictions and increased competition, particularly on price, have seen a market shift from holding long wakes over multiple days to shorter wakes and even direct cremations. However, the Singapore business has successfully pivoted with the introduction of targeted packages to address this change in customer opportunity. This has been a key driver to the 6.7% increase in funeral case volumes that has contributed to funeral case averages remaining at below pre-COVID levels. On a local currency basis, the business has pleasingly experienced growth at a top-line level and in Ebitda. However, the depreciation of the Singaporean dollar against the Australian dollar in the half has meant that translation of earnings from this business has reduced compared to the prior period. The dedicated efforts of our teams on the ground in Singapore to continue to provide high-quality service is reflected in the locally based customer recommendation score, with a consistently high 99% of respondents indicating that they would recommend Singapore caskets to their friends and family. Looking ahead to the second half, earlier this month, the number of attendees at funerals was increased to 30. Singapore is on track to have over 2/3 of its population vaccinated by the end of August, and once 80% of the population is fully vaccinated, which is expected in September, the government is looking to continue its phased transition in opening up its economy, subject to outbreak control. The local team is also consistently focused on maintaining the high service and value-add focus that has sustained earnings in the first half. The newly won Singapore police contract that is expected to improve volumes and brand recognition commenced on 1st July. I will now hand over to Adrian, who will walk you through our financials in more detail. Thank you.
Thank you, Olivier, and good morning, everyone. Consistent with how we set out our strategy presentation in May, this slide summarizes the primary focus areas for us from a financial management perspective. Effectively a scorecard of key metrics, which together will deliver our core financial measures of success, being sustained growth in earnings per share and a satisfactory enterprise return on capital employed. As Olivier touched on earlier, we are pleased to see these two measures have improved in the half, with operating EPS up 57% and our rolling 12-month return on capital employed of 10.4%, up 1.8 percentage points from our full year 2020 result. Both metrics indicate positive early momentum toward delivering on the strong, sustainable group targets identified in our 2025 strategy. Let's now touch on some of the highlights across the four quadrants of the scorecard. In P&L optimization, we are focused on the delivery of improved operating leverage. Pleasingly, the group has successfully driven down the OPEX to sales metric 2.5 percentage points to 51%. A disciplined control of costs constrained the level of cost growth below that of the group's revenue growth, returning the business to positive operating leverage of 2.4 times. This in turn has delivered strong operating Ebitda and EBIT growth. Despite the severe impact of COVID restrictions last year, one of the bright spots of our 2020 financial results was our strong cash flow generation and conversion. This momentum has been sustained into 2021, with strong Ebitda growth and disciplined cash collections, driving operating cash flows of up 59%. Feeding into this picture is the 1 percentage point improvement in working capital efficiency and a cash flow conversion of 102%. We are also keeping track of a free cash flow metric, which we calculate to be operating cash flows before interest paid and after allowing for recurring and platform investment Capex. The growth in operating cash flows has driven a 9% increase in this metric compared to last year. Our capital management focus remains on balancing the importance of rewarding our shareholders with the cash flow demands of sustaining and growing the business. That strong cash flow conversion has delivered a further improvement in debt metrics, driving down interest paid and debt leverage. The strong earnings performance has also allowed the board to determine an increased interim dividend of 9.5 cents, which is prudently within our preferred dividend payout ratio range of 60 to 80%. Although Capex is 16% lower than prior period, a pause on projects in Q1 as the management team underwent the process of resetting the strategy, and delays in some construction projects in the NBO program due to slow development approvals and building material supply constraints, means that the Capex profile is likely again to be weighted to the second half. From a portfolio management perspective, decisive action to invest, restructure, or divest non-core assets while fulfilling the group's investment and strategic priorities is vital to actively managing InvoCare's deployed capital across its portfolio of operations. Whilst there were no material acquisitions in the half, the pet cremation business did acquire the operating assets of the pet disposal business in Metro Sydney. The group also disposed of 3 locations, 2 in Australia and 1 in New Zealand, for combined proceeds of $9.4 million. These disposals are a consequence of network reviews by both businesses, as well as associated NBO activities. As Olivier has touched on, we also signed a subscription agreement for an investment in digital memorialization company Memories. a key step forward in our pursuit of innovative new growth platforms. And finally, as highlighted in our full year 2020 results presentation in February, the program of identified NBO projects is nearing completion. 13 projects were delivered in the half, including one shared service centre. Let's now move on to reviewing the key components of the group's profit and loss performance on slide 14. Olivier has already touched on some of the key movements from a divisional perspective, with continued recovery in funeral case average in Australia and New Zealand, growth in memorialisation sales in our memorial parks, together delivering 13% revenue growth, whilst control of cost growth was limited to 8%, thereby delivering 31% operating EBITDA growth. Some other highlights I want to touch on. In the second half of last year, we executed 3 acquisitions, Galaxy Funerals in metropolitan Sydney and 2 pet cremation businesses in WA and Queensland. Together, these businesses have contributed to first half growth in both operating revenue and expenses. I'll come back to a little more detail on expense movements on the next slide. Set out in the boxed area of the table is the split of operating EBITDA by line of business. Olivier has provided commentary on the drivers of growth in his earlier operational update, but what I would point out is that the New Zealand and Singapore results included in this table are the Australian dollar equivalents. As Olivier touched on, this half, the Singaporean results have been adversely impacted by foreign exchange fluctuations, showing a decline in earnings of 8.6% when EBITDA in local currency has actually grown 4.1%. The foreign currency impact is approximately $500,000 in lower earnings to the consolidated group. I'll explain the increase in support costs on a subsequent slide. The Capex investment in prior years is driving the step up in depreciation and amortization expense, albeit $1.1 million of the increase is from accelerated depreciation of leasehold improvements attached to our old North Sydney head office premises in Miller Street, following our relocation around the corner to Mount Street in June. This relocation also gave rise to an accounting non-cash gain of $1.5 million on the right back of the exited lease obligations. One should really net these two items when thinking about the total impact of the relocation on the P&L. All this has driven a 46% increase in operating EBIT, despite the increase in D&A expense. Those of you familiar with the InvoCare financial statements will know that non-operating EBIT primarily reflects the results of our prepaid funeral business. A breakdown of this amount into revenue, costs, and mark-to-market revaluations is included on the next slide and in the operating to statutory reconciliation provided in the appendix. Suffice to say, the continuing volatile nature of the mark-to-market revaluation underscores why we have chosen to separate out the results of this business from the main operating results of the group. At 30th of June, this asset revaluation yielded an unrealised gain of $38.6 million, in distinct contrast to the $29.3 million loss for the prior period. I'll come back to this in a little more detail on the next slide. However, the materiality of that swing has meant the group's reported or statutory earnings after tax has also increased significantly, up $62 million to $44 million for the half, compared to an $18 million loss for the prior period. Finally, on this slide, net finance costs declined, reflecting the benefits of lower leverage in terms of interest margins charged and debt repayment in the prior year following the capital raise. This contributed to a $2.7 million decrease in interest charged, with the other $2.1 million relating to the cost recognised in the prior period of extinguishing an interest rate hedge linked to that debt repayment. The swing in tax expense for the group is primarily linked to the movement in the net revaluation gain on prepaid funds under management. Now, as promised, on the next couple of slides, I'll provide a slightly deeper dive into operating expenses, non-operating EBIT, and support costs. Improved cost control and a heightened focus on OPEX to sales as a key management reporting metric has had some success in keeping cost growth contained and below revenue growth. As noted on the previous slide, $9.8 million of the overall $14.4 million increase in operating expenses is driven by the inclusion of prior year second half acquisitions. That impact feeds through most of the operating expense lines, and most particularly employee benefits, accounting for $5.3 million of the $9.3 million increase for the half. Excluding the impact of acquisitions, the underlying $4.6 million increase in operating expenses can be explained by the following. A $2.2 million increase in finished goods, consumables, and funeral disbursements reflecting increased sales activity. A $4 million underlying increase in employee expenses. $3.1 million of this relates to an increased incentive cost accrual run rate compared to the prior year, and higher sales commissions paid in the cemeteries and crematoria business, given their strong sales performance in the half. The balance of the increase can be attributed to core wage inflation and the impact of capability investment that I will touch on in a moment. Somewhat offsetting these increases are underlying cost savings in advertising, albeit mostly timing, motor vehicles, and other expenses. In terms of non-operating results, the revenue recognised here relates primarily to the administration fee we earn on selling a prepaid contract. This fee gets deferred to the balance sheet when the prepaid contract is signed and is only recognised in the profit and loss when the prepaid funeral is ultimately delivered. Non-operating expenses include the costs associated with running the prepaid funerals business, including staff costs and marketing expenses, with a decrease coming from a decline in personnel costs. No impairments have been recognised in the half, and as touched on earlier, the funerals network optimisation review has led to the disposal of 3 locations and gave rise to a net gain of $5.8 million on disposal. Finally, and most materially, you can see again the swing in funds under management fair value accounting outcomes for the half. Strong returns on equities, including dividends received and property revaluations, have driven a significant upswing in the prepaid funds under management asset compared to the same period last year. Shown on this slide is the net revaluation, namely the net of the funds under management asset revaluation offset by the increase in the associated liability. As you can see, period on period, that improvement upswing is significant at $67.5 million. Maybe just worth noting here as well, as part of our strategic review of this line of business, we are considering how closer strategic alignment of the prepaid business with the funerals business may impact the way we think about our non-operating disclosure of prepaid revenue and expenses. Whilst comfortable that mark-to-market unrealised revaluation gains and losses should be disclosed as non-operating, it may be that we conclude that the day-to-day operational activities of running the prepaid business, both prepaid contract generation and subsequent contract realisation, would be more properly reflected within operating earnings. This is currently under consideration, and any changes to disclosure approach would be made from the 1st of January 2022 and are not expected to have a material impact on operating EBIT. Now, moving on to support costs. An important area of focus for us, given the existing strong fixed cost structure of the InvoCare P&L, and as called out in our strategy presentation, is control of support costs. Just a reminder here, we consider support costs in 3 distinct categories. Support corporate, the costs of corporate support functions such as finance, HR, legal, listed company costs, and the offices of the CEO and CFO. Over the longer term, these costs should broadly increase in line with wage inflation. Support field. This includes the cost of the marketing teams, embedded field HR support personnel such as trainers, as well as the safety and sustainability, procurement, and property and facilities teams. Broadly speaking, and again over the longer term, these costs should move in line with business unit cost growth and broader activity levels. Support IT comprise the costs of our IT support team, including external support services, and centralized technology costs such as the software license fees for our Microsoft and Oracle platforms. The way to think about cost growth in this area should be twofold. Short-term capability investment, for example, the appointment of a new CITO this half, and medium to longer-term OPEX investment in line with technology-driven strategic imperatives such as digital, e-commerce, and process automation. Of the $4.2 million overall increase in support costs in the half, $1.6 million of this is attributed to the increase in accrual rates for short-term and long-term incentives, as I mentioned earlier, with the accrual run rate in the first half of last year being particularly impacted by COVID uncertainty. Support IT costs increased $1.3 million due to the impact of capability investments and a $1 million increase in software license expense driven by the Oracle ERP rollout, increasing digital investments, and the Microsoft Office upgrade. The remaining increase in support costs is attributed to the impact of capability investments made in safety and sustainability, stakeholder engagement, compliance, and our new EPMO. Important foundational OPEX investments are required to execute on our operational efficiency and sustainable leadership strategic objectives. Now moving on to the balance sheet. Disciplined working capital management, especially the ongoing improvements in the collection of trade receivables and the decrease in inventory from sale of developed crypts and memorials, drove an improvement in working capital relative to December 2020. The improved sales performance has also driven a 1 percentage point improvement in average working capital as a percentage of sales to 13.4%. The overall 3.3% increase in total capital employed from December is driven primarily by the increase in net prepaid funds under management, partially offset by related tax items. In addition, the business has continued to invest capital in property, plant and equipment, including the NBO program, and increases in intangibles arising from the continued capitalization of IT development costs. At this point, I should also draw your attention to the new IFRIC pronouncement on the treatment of capitalized software development costs in relation to software as a service implementation contracts. Like many other listed entities, we are assessing the potential impact of this decision on costs currently capitalized to intangibles on the InvoCare balance sheet, and will conclude this in the second half and as part of our year-end finalization processes. And next to cash flow. As noted in our opening scorecard, cash flow generation and conversion continues to be a positive feature of InvoCare financial performance. The group ended the period with cash on hand of $131.2 million. A strong sales half, disciplined focus on cash collections, and a reduction in finance costs paid has led to growth in operating cash flows of 59%. This has also led to improved cash conversion at 102%, as more earnings were converted to cash. The reduction in net investing cash outflows for the period of $3.8 million includes proceeds of $9.4 million from the disposal of the 3 locations I referenced earlier. Capital expenditure of $23.5 million in the period included $8.2 million of NBO-related expenditure and $5.8 million on shared service centre projects and IT. The remainder relates primarily to maintenance Capex and other plant and equipment purchases. Net financing cash flows includes the payment of the 2020 final dividend and principal payments in respect of leased assets, primarily property and motor vehicles. Set out on the next page is further detail on the Capex spend in the half. Recurring or maintenance Capex includes minor capital works and leasehold improvements, the purchase of equipment like cremators or AV equipment, and normal course IT software and hardware purchases. $1.9 million of the increase in recurring Capex has come from leasehold improvements associated with the support office relocation previously mentioned. In this case, the group has taken advantage of softer commercial property market conditions and relocated the corporate support office to new premises in North Sydney. There has also been a $500,000 increase from AV system upgrades as the program was extended to a further 16 locations in the half, including 3 in New Zealand. Platform investment of $5.8 million includes $0.8 million related to shared service centre projects, with a centre delivered in Cairns in the half. Just over $3 million was spent on Compass 2.0, a significant enhancement to the functionality of our new Oracle ERP system for funeral arrangers. The successful implementation has gone live and increases flexibility and transparency through an automation of associated procurement processes and client invoice generation. The balance of spend was on other key operational efficiency projects such as the new payroll system and other new digital tools. In terms of facilities investment, $8.2 million was spent on identified NBO projects in the half, and we completed 12 projects, including 7 refresh, 2 enhance, and 3 growth sites. We have set out in the appendix a summary of these projects in a similar format to what we provided in our 2020 full-year results release. As I noted previously, not dissimilar to last year, a ramp-up in delivery activity is expected in the second half, albeit increasing COVID restrictions may continue to hamper this. Finally, I note that depreciation and amortization, excluding the accelerated depreciation on the exited support office lease of approximately $24 million, is broadly in line with the guidance provided for 2021, as included in our full year 2020 results presentation. The second half will likely see a slight increase in run rate compared to first half. Now, very quickly on the capital management slide, because we've already touched on most of the salient points. Strong cash generation and improved cash position has driven a 9.3% reduction in the group's net debt as at 30th of June to $124.7 million. This has also contributed to a further improvement in the group's debt metrics. The growth in our operating EPS of 57% is also a very pleasing result, particularly as we are cycling a step up in the number of shares on issue following the capital raise last year, and clearly reflecting the 78% increase in operating profit after tax. This in turn has enabled a 73% increase in the interim dividend, while still ensuring we remain within our preferred dividend payout ratio of 60 to 80%. And finally, as some may have already seen from the ASX announcement last Friday, we have successfully concluded a limited restructuring of our debt facilities. As highlighted to you when we presented our 2020 financial results back in February, and again when we presented our strategy in May, a key initiative in the operational excellence pillar from a finance perspective was to ensure our debt financing was set up to best support the business going forward. The group now has access to $375 million of loan facilities, including a 10-year, $100 million note purchase agreement with MetLife, fully drawn and due for repayment in February 2028, a 3-year syndicated debt facility agreement supported by ANZ, Westpac, Mizuho, and SMBC, providing $275 million of available funds through a multi-currency revolver with a tenor out to the end of August 2024. And that concludes the financial section of the presentation. I'll now hand back to Olivier, who will take you through our strategy focus and outlook for the balance of the year.
Thank you, Adrian. So looking ahead for the balance of the year, our strategic focus for each of our 5 pillars includes: first, following through on the learning from our employee survey and enhancing our call center and digital assets to ensure we capture and convert more first calls and make it easier for customers to find assistance from us. In the second half, we intend to complete another 25 to 40 NBO and shared services projects, depending on restrictions, as this initiative approaches conclusion. System investments will include both a broader ERP deployment and a new payroll and time and attendance system to improve workforce efficiency. Platform enhancements enable us to optimize our existing funeral footprint and commence a return to logical small M&A bolt-ons. We are updating the Simplicity brand's collateral, and within this brand, we will be piloting new digital tools for arrangers. We will embed the Memories partnership, which I will cover in a minute, across our businesses, focus on new value-add services directly or through partnerships, and continue our program of B2B engagement, as these agreements offer opportunities to secure larger volumes from a single engagement. We aspire to lead the industry on safety and standards of care. In the second half, we are updating our preventative safety management plans around our greatest and most frequent risks. We are also making continued improvements to raise the bar on our back-of-house operations, including an upgrade for security devices. The ACCC is yet to release its report on its review of the sector, but as noted previously, InvoCare is supportive of regulation that protects customers' interests, including minimum standards across the sector. So we recently announced our partnership and investment in Memories, an Australian startup who has developed a world-leading offering in digital memorialization. We will commence the rollout of this throughout our funeral homes in the second half. Our $4 million investment for a 9.6% stake recognize our strategic contribution and the potential of our partnership. We have representation on the board, as well as the potential to unlock a greater equity share through the success of our partnership. InvoCare funeral directors will sell Memories timelines and unlock incremental case average growth, and importantly, the Memories platform can be used across our entire business. We see digital as an important prevalent part of the funeral service, with streaming and upcoming digital tool developments being two further examples of the work we are doing in that space. Throughout much of this half, the business was able to operate in close to normal operating conditions, and this contributed to a strong result. However, the start of the second half has seen protracted and intermittent lockdowns throughout most of Australia and more recently in New Zealand. With earnings weighted towards the most affected eastern seaboard, we expect a softening in case averages. Whilst we will not provide an earnings guidance, we see the second half as challenged by potential volume impacts from lockdowns and limited flu season in Australia, and attendance restrictions and stay-at-home orders driving case averages down during lockdowns. Over the long run, we remain confident in the strong potential of InvoCare. The death rate across our 3 countries is expected to grow on the back of aging populations. Our operational excellence initiatives are delivering green shoots with a return to operating leverage seen throughout the first half. Significant opportunities exist to internalize and diversify revenues and expand into new adjacencies. And importantly, I am really encouraged by the opportunities ahead and the momentum of our teams and businesses behind the raising the bar phase of our 5-year strategic plan. Finally, I wish to thank our employees across Australia, New Zealand, and Singapore for their outstanding commitment, care, and service to our client families in what is a challenging and often fast-changing environment. That's it for the formal part of our presentation. We will now open the call for any questions you may have. Thank you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Russell Gill from JP Morgan. Please go ahead.
Hi guys, handful of questions. Just firstly, breaking down the case average growth in your funeral Australian business, which is quite strong at 6.7. Can you possibly give us a bit more detail on that in terms of, you called out, I guess, opening up of locations, but also flower spend, but what was the breakdown, I guess, between price rises and then mix within that 6.7?
Thanks, Russell. And I think it's been mostly, as I mentioned, in February and then in May, our focus is increasingly on case average and share of value rather than share of volume. So our volume was quite flat in this environment. Our increase in case average is a number of things. We've got new services coming through. we didn't put, big price increases during this half in the environment. So it's more a return to the ability to sell flowers, catering, gathering and services during the half as we had limited lockdowns. There was not much of a mixed effect, as a matter of fact, during the half that impacted our funeral case average.
Great, and then you've now traded 2 months, particularly with quite large restrictions in New South Wales and also Victoria, which I guess you're cycling year on year. But July, August are probably your biggest months, historically speaking. Can you give us a feel for July, August, how that case average has actually moved on the PCP?
It's not been as important as we thought it would be in July. I think the teams have done an extraordinary job to compensate. The volume has been actually strong. The case average has been slightly impacted, mostly in New South Wales, as you would expect. I think the main impact, as I flagged during my presentation, is more on our cemetery crematoria business. We've got some of our largest parks in some of the 12 locked LGAs. That has driven quite a drop in frequentation of our parks, in willingness and comfort of customers to come and buy some memorialization. So there's been a lot of deferral of appointments. So it will really depend on the duration of lockdowns and when people will feel comfortable to come back. So it's hard to have a really strong read-through. July was lower than expected because of some case average impact, as I mentioned, in both New South Wales for funerals mostly and some crime.
I just a question on that, Olivia. How do you manage the business through these next couple of months? Because usually increases the variable labour as well through these months. What's the cost base tracking out on, I guess, in that variable labour and moving people around, given the restrictions, particularly in New South Wales, are quite different LGA by LGA?
Yeah, that's a challenging one. And as I flagged, in recent months, we are working hard to improve our workforce flexibility, but a lot of it has to be driven by systems enhancement. We're rolling out a new payroll system in November, and we'll follow up early next year with a time and attendance system. Currently, our timesheets are paper-based, so it's been quite challenging. I think the positive is we've worked very well with all our employees and the unions. We've renegotiated 5 EBAs, in the last 8 months. And I guess, in terms of the way we've approached these negotiations is to allow the business to have more flexibility, to rely less on full-timers only, but more part-timers and casuals, review our shifts, review the overtime, review weekend work. So we've built in a lot of flexibility in these arrangements, which will really help navigate. I think that's why, I think the funeral business has done very strong work on cost management in July, because we've got much more flexibility embedded, but we will still benefit from having better systems to all the team in each cluster to really manage tightly the workforce. That is still a lot of paper-based work. I think in our parks it's a bit more challenging. I think the team is looking at ways of working through people taking more leave and how we work through that period. But no doubt that will have an impact when we've got hard lockdowns. Similarly, when you see in South Australia for a week or in New Zealand when funerals are not allowed, it has definitely an impact. So I think we'll navigate through these things, but we really rely on our employees to be there on the other side for us. It's challenging in this environment with low unemployment to recruit and retain good people. So we really want to work with our workforce, positively, and make sure we come both stronger on the other side.
Great. 2 more questions. Just the first half, I guess the result you called out had less restrictions than you've seen for, 12 months. So it gives you a better run rate feel. There's still the tail end of NBO occurring, and the ramp up of sites, it does take time to get back to operating level. Is it possible to give just a broad feel for, what percentage of capability you think the organisation operated at the first 6 months, in terms of sites closed or those in ramp-up stage? What sort of level of operating capacity or capability were you operating at in that 6 months?
Clearly, we didn't have many material sites closed ourselves, so I think you could assume that we didn't have much disruption from NBO. I think when you think about the operation capacity, we still have a lot of work to do on our shared services. It's fair to say that a lot of our NBO program has, privilege first, shop fronts and enhancement, but we still have some work to do on shared services. And to work really efficiently, I do need these shared services open. As you would have seen in Canberra, when you've got a central point for mortuary care, for fleet services, for admin, for coffin storage, we work much more smoothly. So I do need that to be in place more consistently across the network, and that's still work in progress in Australia and New Zealand. We still have a number of growth sites. I flagged in the presentation both in Australia and New Zealand. We are currently performing network reviews. Because all the NBO has been predicated on data from 2016, we've been revisiting that, looking at demographics, looking at 3 and C changes, where people are retiring, where the multicultural communities are living, and that influences us to do some tweaks to these networks, in terms of new growth corridors that could open for us, given the growth, coming through for the baby boomers in the coming years. So we'll do some more tweaks for more sites coming through, which are not currently in the NBO plan potentially. But the operational capacity was good in terms of no material NBO, constraints, but there's more we want to put in place. So the challenge was more, not everyone was comfortable to do big gathering because of the uncertainty of, you don't know what you don't know. So a lot of families were not traveling cross borders, obviously. And so we were still relying a lot, as we will, on video streaming.
Great. And then final question, and Adrian, you did give a bit more breakdown on, I guess, the detail within that support cost line. Is there a way that you could possibly provide us, more detail around, I guess, the drop through or the operating leverage that you guys think you'll be able to deliver from the top line? So when or if volumes do improve, I guess how much of that revenue uplift on volume per se is caught or flows through to Ebitda?
Yeah, sure. I think when we presented the strategy earlier in the year, I think we targeted a preferred, operating leverage in that 2 times and above type range or level. So clearly, that's where we've got in the first half. So to Olivier's point, in terms of having that clean air, if you like, for the business to be able to operate, somewhat unencumbered by restrictions. So I think that's showing what the business is capable of. I think maybe just to build on it a little bit more is clearly we're only 6 months in to a 5-year strategy, and I think we've made note of the fact that there's a reasonable amount of foundational improvement that we think needs to be addressed. And I think as we get the other side of that over the course of the first sort of 12 to 18 months, that's clearly going to feed into that improved operating leverage.
Great, thanks, guys.
Thank you. Your next question comes from Mathieu Chevrier from Citi. Please go ahead.
Good morning, Olivier, and good morning, Adrian. Thank you for taking my question. Maybe just on the revenue, you talked about increase, focused on share value going forward. I was just wondering, obviously the second half is going to be impacted by the pandemic, but on a run rate basis, what kind of case average growth do you think you can get? And I guess the split between pure price increases and increased offerings / mix.
Yeah, that's an interesting one. I guess I think the second half is difficult to pin because that really depends on the shape and duration of the lockdowns, because that always impacts our wakes and ability to sell catering. So I think the way we want to think about it is to enable these services anyway. So for example, in the last month, we've implemented a flowers e-commerce solution for parks. So in some of our parks, the customers, if they can't go to the park, they can go online and ask for some flowers to be delivered. So we try to enable that digitally. You will see more and more digital tools that we will roll out. As I flagged, the Simplicity is one of the brands we are going to digitally enable the most initially. but that will be rolled out in our other brands as well. So that will really allow us to sell more services, beyond just price increases, because we want to rely on, increasing our case average on the back of better and greater services for our client families. So I think florals, memorialization, we are working on expanding our range of jewelry, urns, for cremation, mourning stationery. We look at our multimedia offering. We look at what we do in-house in terms of celebrancy, because sometimes celebrancy is external providers, but sometimes we do it in-house. We look at grieving support services. So there's a range of services we are currently looking at to support long-term or case average, and not only by increasing price on the back of our labor cost increases. So I don't have a direct mix, to answer to you, but definitely you would have seen some of our overall targets in terms of EPS growth over the cycle of the 5 years, as well as return on capital growth. And a lot of it will have to be supported by case average growth, as we know roughly where the case volumes will be. We won't be chasing market share, so we're assuming a flat market share, at minimum. We know what percentage growth we will have in volumes. So we're really looking for, increasing case averages, and then over time we'll increase through M&A as well.
Yeah, okay. That's fair. And in terms of cost control, you mentioned employee costs. It's by far your biggest cost, and you expanded on that during the prepared remarks. Looking at the entire cost base in terms of OPEX, do you think that kind of a 3-4% growth would be what you would expect in the normal kind of year?
I think that's what we conservatively have as the underlying liability growth assumption in our fund under management, to give you a sense. So based on historical long-term, that's what the accounting makers do for our fund under management liabilities for the prepaid business. So it's a good indication of a conservative growth you can apply to your cost base. We'll try to improve that. I think Adrian touched base on operating leverage. We want our cost to really reflect our scale going forward. So a lot of our investments in ERP, a lot of our investments in payroll and time and attendance is really to enable us to flex that cost base, especially labor costs going forward. The renegotiation of the EBS with unions to enable more flexibility, and the way we think about more, part-timers and casual workforce, and how we use shifts and weekend work and so on, is also to enable us to not carry the same cost base every single day of the week, given we've got flexibility during the week, seasonality during the week. So I think I'm quite comfortable that we'll be able to flex that cost base. As Adrian pointed, we still have some operational efficiency work to do in the next 12 months, so that will take some time to really be fully enabled in our business.
Yeah, I might just step in there and just add a little bit. I think Olivier's absolutely right. That's the right way to broadly think about it. I think maybe also worth remembering is employee costs is a significant part of the cost base, which is, I think, is probably the point you're also getting at. So clearly it's going to be driven by underlying wage inflation. So bear that in mind. I think the only other thing is just a reference back to the commentary I gave on the different areas of support and how the costs in relation to those three categories move, or our expectations of how they're going to move over the longer term, because I think that's relevant as well. So there'll be certain parts of the cost base that we actually want to invest from an OPEX perspective, and clearly in and around IT, because it'd be such a big driver of a lot of process automation and other digital improvements in the business. We'll probably over-index in that area, but seek to constrain cost growth in other areas where we can. So that's very much the approach that we're taking.
Yeah, understood. Thanks for that. And maybe just one final one on the memorial business. Do you have to invest significantly more capital going forward to grow that business, or do you have, some visibility in plenty of room to grow? Let's say over the next 5+ years.
So I think it's a good good question. We definitely have a lot of room to grow. I think we still have in most of our 17 parks, we still have quite a long run remaining life of the parks to memorialize. And it also depends on the future mix of customers wanting to memorialize ashes or burials. So we still have a lot of room. We also have a lot of strategy to make our memorial park more a destination. So we don't have the same service offering into every single park for our InvoCare, non-InvoCare funeral directors and for our client families. So when you think about cafes, florists, how we could have different services we want to enable. We are doing a lot of work on innovation, and there are a lot of interesting products and services that we've looked at overseas that could be an interesting enhancement to our parks offering, especially in a constrained travel world where not all the client family live in the same state as their loved ones. So we do think we've got a great runway to expand within the perimeter of our parks. But this being said, there are also some strategy we're looking at to expand the footprint, either memorial parks, but also connectors, standalone to support, some of our InvoCare and non-InvoCare funeral directors in their connection needs. So I think we're looking at both, but we still have a lot of room to grow within the perimeter of our parks.
Great. Thanks very much.
Yeah.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. Your next question comes from Sam Haddad from Bell Porter Securities. Please go ahead.
Good morning, Olivia and Adrian. Did I hear you correctly to say that volumes were pretty strong in July, or did I just want to get a feel for how volumes are tracking coming to the second half, please?
Yes, I'm on the Australian funeral business. Yeah, the volume were solid in July, so there was no impact, if you see what I mean, from what we expected versus the lockdowns. And the impact was really focused on case averages and the ability of the customers to have a gathering or to use catering and so on during the lockdown, especially in New South Wales.
So the read through that is a return to growth in volumes in July?
Yes. Well, last year had still some impact of lockdown, so it's always hard to compare with 2020, unfortunately, depending on which month you compare to. So that's why I wouldn't want to make too many, conclusions from the 1 month comparison, because a lot of things happened last year, a lot of things happened this year. But I think the main impact we've seen to date, if I take New South Wales, is mostly a case average impact more than a case volume impact. It can be different, as I flagged, it's different in New Zealand because New Zealand couldn't authorize, burial for a period. So obviously that impacts, volumes and what people want to do and so on. So it's quite a mixed view so far across the states, but in the main states we haven't seen a drop in case volumes in July.
And given you had more free air through the first half, can you comment around performance of renovated sites versus those that are yet to be renovated? Any metrics around that versus KPIs, things like that?
So we haven't done a detailed rec. I think and I'll be honest here, I tried to flag it in May during the Investor Day. It's harder and harder to compare like for like because we've got some clusters where we now have a strong location cluster manager in place. We start to have some digital investments. We've got a shared service in place, or we don't in other clusters. So it makes the comparison harder and harder to compare. And over time, we really want to work on not only the property investment, but the IT, the digital, the people, the marketing, the website investments all together will impact our return on capital employed. So more and more we're moving to ROC. This is why we haven't put a comparison of MBO sites, by cohort and so on this time, because it becomes really difficult to make a meaningful comparison to prior periods. But the sites have been comparing well, so it's contributed to a strong revenue growth. So I'm quite pleased with the performance of the sites, with some exceptions where, some sites have been decided in 2016, as I flagged, and potentially the movement in population have not followed where we thought they would. So we'll make a few tweaks and minor adjustments to some locations or some brands across our networks on the back of that review.
Thank you. And can you give some colour or some numbers around Capex outlook for the second half and 22, like maintenance and to support those renovations that are left?
So I may let Adrian to answer this one, maybe.
Yeah. I think we've maybe hinted at the fact that whilst we're expecting a ramp up in second half activity from an NBO deployment perspective, clearly that's going to be governed by COVID lockdown restrictions and our ability to actually get on the ground and do what we need to do. So, I think broadly speaking, we gave Capex guidance in our 2020 results. It wouldn't surprise me if we come in less than that, given maybe the slower ramp up in the first half and maybe some constraints in the second half. So beyond that, for 22, we haven't really given definitive, capital deployment guidance. I think probably the better time to do that is maybe in our final financial results for the year, because we'll have a clearer view of what we've been able to complete in the second half. We gave some indication of what that forward profile may look like, I think, in our strategy deck. So maybe point you back to that deck. I think in terms of recurring and maintenance Capex, we continue to hold firm to the rule of thumb of that Capex being broadly in line with D&A, excluding AASB 16. So it started moving towards that, but it's still some way off getting close to that core D&A number.
Thank you. And final question, just on acquisition opportunities, are you primarily focused on the organic that organic strategy in terms of improving the operating efficiencies, or are you keeping an eye out for other prospects of acquisition, maybe in offshore markets as well?
So we're keeping an eye, mostly domestically in our markets, because we both in terms of funerals and pet cremation. It hasn't been a massive focus because I didn't want to distract the teams. As we flagged, we do have a lot of operational efficiency work we wanted to land well. Our ERP in funerals was a big pain point from 2 years ago in terms of the change management approach and what it left the team with. So we made significant improvement in a very different process, and it's been received very well by the field, but it required a lot of work from many people. And so I didn't want some of the management teams to be too distracted, but we've been keeping an eye. We've got some dedicated people who focus on strategy, innovation, and M&A. So we may do a few, in the front half, but it's not a major part of the strategy, as I flagged. Second phase of the 5-year plan definitely will put the accelerator on opportunities to go faster, but it may depend on the type of services and adjacencies we want to go into. It may not be, the same traditional brick and mortar funeral home.
Yeah. Thank you for your time.
Thank you.
Thank you. Your next question comes from James Bales from Morgan Stanley. Please go ahead.
Hi guys, thanks for taking my question. I'd like to better understand the cost base in the funeral business. How much of the initiatives that you've put in place are still to annualise into the second half, and how much can you improve from here versus the 44% OPEX to sales number that you reported?
So I think you would have seen a lot of some of the investments we've made, James, are actually in the support, cost area. So some indeed impacted the field and the IT support, so it did impact, our funeral business. So there will be some annualization of some cost increase there. We don't have a target yet on the OPEX to sales. We are going into strategic replanning and budget in the next 2 months, to actually review all of this. So we haven't pinned the number yet because it's very hard to read, the first 8 weeks of the year in terms of, we do now a forecast, every month, but it's been very hard to get the trends from the opening and closing of lockdowns. So I think we still need to do a bit more work when we've got stabilized view of all the lockdowns impact to really see what happened in the second half. So second half will probably be noisy in terms of what the months allow us to do. So I think into next year we'll have a full annualization of the cost, which will be much easier. I don't think we're aiming to have a much lower, opportunity on OPEX to sell in the short term. I think the next stage will come when we can grow this business on the back of fully enabled IT systems and process efficiency on shared service. So that will come in the second phase. I don't know, Adrian, if you wanted to add something on this.
No, exactly right. I think I'm not necessarily thinking in terms of setting OPEX to sales metric targets. Clearly that metric is going to be governed by what we do on the top line as much as what we do in constraining cost growth on below that. So I think that's something that we'll take away, and as Olivier says, we'll look at that from a strategy and budget process coming up. I think what I would say is it's not always easier to exactly pinpoint the efficiency gain you get out of an ERP deployment. So what we got out of Compass 2.0 actually was funeral arrangers spending significantly less administration time messing around with an ineffective initial cut of the deployment that we did. So in addressing that and getting it right in the first half through Compass 2.0, what it actually means is that funeral arrangers can spend more time doing what we want them to do. It probably feeds more into the top line than the cost line, maybe. So that's just an anecdote. Probably.
Yeah, I guess what I'm getting at is sort of ignoring the second half and the lockdown impacts. It seems that the leverage that you got in the funeral business was quite material, and I wanted to understand whether we should sort of think about that as the new run rate, or that was only a part period impact and the improvement's still ongoing once COVID normalises.
I think that's one of the...
Yeah, go on, Olivier.
Okay, so I just think in the beyond lockdown, I think you may see some incremental still improvement in the, short term. As I said, I don't think we should bank on big step change in improvement until we can grow the business a different way on the back of, the time and attendance system and all the shared services. So I think I would see more incremental further improvement in the next 12, 18 months before we can get to a different stage of, potential cost leverage.
I think that's right. And the only thing I was going to add was, clearly the second half of last year saw a gradual improvement in the business as we exited lockdowns. So that's obviously going to feed into the period-on-period comparisons in the second half.
Great, thanks for the colour.
Thank you. Your next question comes from Mitch Sonogan from Macquarie. Please go ahead.
Good morning, Olivier and Adrian. Thanks for taking the question. Just first up, just on the portfolio management, talked about 3 assets being divested. Can you just talk through the drivers behind that, and should we expect any more? And maybe just following on from that, what impact that might have had on the cost base as well? Thank you.
Adrian, can I let you this one?
Yeah, I can probably take that one. I wouldn't actually read too much into it from a materiality perspective, Mitch. It's not that significant. I think, what we've done and will continue to do is proactively manage the portfolio. Clearly, the network optimization reviews in both New Zealand and Australia will consistently inform that, and I think Olivier touched on the way in which we were thinking about that from a broader network perspective. And what that means is that, where we don't believe that we're optimally placed, or we've identified surplus property. So a couple of these divestments were property sales because we no longer needed the property or didn't need to be in that location. Then we'll look to divest. And in terms of impact on cost base, just not material.
Yeah, I think just Mitch, to add to Adrian, there were property sales, and as part of NBO, but also as part of the current network review, if we believe we are not in the best location going forward for client families, and often it's driven by parking on the back of growth. If we think of parking is constrained and we're in a residential area where parking access and so on becomes more and more difficult or traffic, we relocate. And so we don't keep properties, in residential areas. We don't use them for the business, and we do highest and best use and just recycle them to sell them. So that's what you've seen here, and you will probably see ongoing. There's always going to be a low single-digit number of properties recycled through, because our funeral homes, date decades ago when the demographics were quite different around them. And if the parking becomes really constrained, then we move, and that's what you see being cycled through.
Yeah. Okay, understand. Thank you. And Olivier, just a broader one about the environment. The case volumes were pretty flat, but just interested in how you're seeing it from an industry volume perspective. Just looking at the ABS data for the first, sort of 5-6 months of this year, it looks like it's tracking, 5 to 10% above the average over the last 5 years prior. So it actually looks like it's pretty strong, which, given there has been very low numbers of influenza, that's a little bit surprising. So maybe can you just talk through if you do think you held share in the Australian market, but I guess number two, how you think about overall volumes if we do see influenza kicking back in 2022?
Yep. As I said, that's something we're interested, but we're not focused on. We don't focus on the market share and volume. We didn't have an acquisition-driven strategy, in the last 6 months. So when we look at the near finalized numbers, and as you know, in Australia, it takes some time. I think the final ABS numbers will be available in September for last year. But calendar year last year, we know we grew market share slightly in Australia. I think we went down 2.5%, the market went down 3.1%. It reverted on the back of last year. It started to increase again in the first half. But we haven't been, trying to acquire market share or focus. We had some mixed effect, across our region. So I think we've been gaining market share in some states, but declining in others. And that's linked to the work we are doing on our brands, making sure we've got the right brand in the right market for the right demographics. In sub-markets, our brands are just not the optimal portfolio, for the current demand and demographics and multiculturalism. And that's why we've done this phase 2, in a way, network strategy review to really revisit that. And that costed us some, market share drops most likely in some parts of some states. So that's what we try to address. So I wouldn't be surprised if we had, had a tiny decline in market share in some states in the first half, but the numbers are very hard to read, consistently. I think in Singapore, we increased market share of late. And I think in New Zealand, because we've been refocusing the business, and we don't try to get as much of a market share of the low value segment as some other competitors do. So we may have, and when it grows, doing sometimes we don't get as much market share there. So we may have declined slightly in New Zealand, in the early months of the year, because we haven't focused on the low value, cases. But I think, what matters to me is really profitable growth. So I really want to make sure we focus on the segments that are most profitable as well, and not chase market share for the sake of chasing market share. So we'll have to wait to see the first half, Mitch.
Yeah, okay. And just on the pet cremations business, are you able to give us any update there on how that's tracking? Have you seen growth continue on at pretty similar levels to when you first acquired it, or have you actually seen some acceleration there with it being under InvoCare ownership? Thanks.
Business is indeed very pleasing. I think, as I flagged briefly, we are well above our acquisition business case. All the businesses are tracking very well. We retain the owners. There's a lot of innovation, product and services there. The demand is very strong. The long-term growth of that segment is going to grow because of the step change in pet ownership we saw during COVID in both Australia and New Zealand. So we're very pleased with the business. We're investing into cremation
capacity. We are recruiting in that business to increase the workforce. So it will be a stronger contributor than we expected for the year's Ebitda. The impact of COVID has been quite limited. It's mostly one of, processes adjustments, like client families are not always comfortable anymore to have anyone entering their home. So it's more the process of, collecting the disease pets from client families which have changed, but the volume has remained very strong, across Australia. So that's a business we want to continue to grow. We've got very strong relationship. It's a 80% plus B2B business with veterinary networks. We've got very strong relationship with national veterinary networks. Some of them were integrated on the IT to provide full visibility and tracking for the veterinary customers of where their pet is at each stage of the process. So it's a very smooth, integrated process. So while the case average is very low, it's a volume business, and on the back of very strong efficiency, we're going to invest in that business further.
Yeah, thanks. And just a really quick final one from me, just for Adrian there. Just on the FY21 guidance you provided back at the full year 20 result, just on the interest expense of 23 to 25 million, is that what we should still expect for the full year? Thanks, guys.
Yeah, Mitch, it's a good call out, and clearly the restructuring of the finance debt facilities is going to help. That won't actually kick in until the back end of September, so it will be a muted impact on this year, more of an impact on next year. I think 23 to 25 is probably the right way to think of it, but maybe more towards the lower end of that range. Clearly our run rate in the first half was below that run rate somewhat. So we'll just have to see how the impact of the operating environment flows through into the core of the business in the second half. But I think probably that lower end, and maybe a little bit below that.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Chrétien for closing remarks.
Well, thank you everyone for listening to our calls, and I wish you a great day, and some of you talk to you very soon through your analyst calls. Thank you. Have a great day.